In October 2008, while the world was convinced capitalism was ending, one man wrote a newspaper article with 4 words that quietly made him billions. Be greedy when fearful. That man was Warren Buffett, and the article was titled simply, Buy American, I Am. While Lehman Brothers collapsed and banks were failing one after another, he was buying. Today, I want to break down exactly what Buffett actually did during that crisis, why it worked, and what he is doing right now in 2026 that almost nobody is talking about. Because here's the thing that most finance content gets completely backwards about Buffett. People think his genius is picking the right stocks. That is not his real edge. His real edge is psychological. It is the ability to stay completely silent and rational while everyone around him is panicking, selling, and making the worst decisions of their financial lives. Let me take you back to September 2008 because the sequence of events that month is genuinely one of the most important case studies in all of investing history. Lehman Brothers filed for bankruptcy on September 15th. It was the largest bankruptcy in U.S. history at the time. The stock market lost trillions of dollars of value within days. Bear Stearns had already collapsed earlier that year. AIG needed an $85 billion government bailout just to survive. The entire global financial system looked like it was unraveling in real time. Buffett himself called it an economic Pearl Harbor on national television. He was not pretending the crisis was small. He understood exactly how severe and dangerous the situation actually was. And yet on October 16, 2008, while the S&P 500 was down more than 40% from its peak, Buffett published an op-ed in the New York Times explaining why he was buying. Here's the exact sentence that I think every investor should have framed on their wall. A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. That sentence sounds simple. Almost too simple to be useful advice. But the actual execution of that principle requires a level of psychological discipline that almost nobody actually has in the moment. Let me show you specifically what Buffett did with real numbers because the theory only matters if you understand the scale of what actually happened during those months in late 2008. On September 23, 2008, just 1 week after Lehman collapsed, Berkshire Hathaway invested $5 billion into Goldman Sachs, preferred shares paying a 10% annual dividend. Goldman Sachs was one of the most respected investment banks in the world, and at that exact moment it could not raise capital anywhere else under reasonable terms. Fear had completely frozen the credit markets. Buffett also received warrants to buy $5 billion more in common Goldman stock at a fixed strike price. This is the part most people miss. He did not just buy at a discount. He structured the deal so that if Goldman recovered, which he believed it eventually would, Berkshire would benefit massively from the upside. This was not charity. This was calculated conviction. A few weeks later in October 2008, Berkshire made a similar move with General Electric, investing $3 billion in perpetual preferred shares with a 10% dividend and warrants attached. GE was the symbol of American industry. Its stock had been crushed in the panic. Buffett's public statement of confidence in GE's leadership helped stabilize sentiment around the entire company. And in that same period, he personally shifted his own bond-heavy personal portfolio into U.S. stocks. Not Berkshire's money. His own money. He was putting his own capital where his words were. Here is the part of the story that gets skipped in almost every retelling. Buffett was not buying randomly during the panic. He had been preparing for this exact moment for years before it happened. Before the 2008 crisis hit, Berkshire was sitting on roughly 66% cash relative to its total investable portfolio. That cash position did not happen by accident. It was deliberate and patient preparation. He had been holding back capital during the years when the market felt expensive and exciting, refusing to chase the housing boom or the easy credit-fueled enthusiasm that gripped most other investors. While other firms were leveraging up and chasing returns in 2005, 2006, and 2007, Buffett was quietly accumulating cash. Not because he predicted the exact crisis, but because he understood valuations were stretched. This is the silent part of silent millionaire thinking that I want you to really absorb. The discipline happens years before the crisis. The buying happens during it. The two cannot be separated. If Buffett had been fully invested with no cash reserve in September 2008, he would have had zero ability to take advantage of the panic. Preparation created the opportunity. Not luck. Not prediction. Now let me show you what actually happened to those investments because the results validate the entire philosophy in a way that pure theory never could. This is where the math becomes undeniable. The S&P 500 fell more than 50% from its peak in October 2007 to its bottom in March 2009. That is genuinely one of the worst crashes in modern market history. People lost half their wealth. But here is what happened next. In the 10 years following the 2008 crisis, the S&P 500 increased by approximately 130%. Companies that looked terminal in 2009 were setting new profit records by 2015. If you had invested $1,000 Apple stock in early August 2008, near the depths of the panic, that investment would have grown to over $222 by August 2018. 9 times your money. Buffett's specific deals performed even more dramatically. The Goldman Sachs investment alone generated billions in profit for Berkshire once the warrants were eventually exercised and the preferred shares were redeemed. None of this happened because Buffett had secret information. None of it happened because he could predict exactly when the bottom would arrive. He could not, and he has said so repeatedly over the years. What he had instead was a framework. A way of thinking that allowed him to act rationally while almost everyone else around him, including extremely smart and experienced investors, were acting purely on fear. Let me explain the actual psychology behind why fear destroys investors during a crash, because understanding this mechanism is more valuable than just admiring Buffett's track record from a distance. Daniel Kahneman and Amos Tversky's research in behavioral economics found that losing money feels roughly twice as painful as gaining the same amount feels good. This is called loss aversion, and it is universal. During a crash, your brain is not malfunctioning when it tells you to sell. It is doing exactly what evolution built it to do: react strongly and immediately to a perceived existential threat. The problem is that this evolutionary wiring, which served us well when running from physical danger, is catastrophically wrong when applied to long-term investment decisions during temporary market panics. Buffett has spent decades training himself to recognize this exact biological signal and then deliberately override it. He has said many times that investing success requires temperament more than intelligence. In his 2018 shareholder letter, he wrote that markets occasionally do crazy things, and seizing the opportunities this creates does not require great intelligence or a finance degree. It requires emotional discipline. He specifically said that what investors need is the ability to disregard mob fears or enthusiasms and focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period is essential. Read that sentence again. A willingness to look unimaginative. Buffett is openly telling you that looking boring and uninteresting during a crisis is not a weakness. It is the actual strategy itself. This is exactly what Silent Millionaire is built around. While everyone else is being dramatic, loud, and reactive, the people who actually build lasting wealth are being quiet, patient, and unimaginative on purpose. Now let me bring this fully into 2026 because Buffett's exact same playbook is happening again right now, and very few people are paying attention to what it actually means for the current market. Warren Buffett stepped down as CEO of Berkshire Hathaway at the end of 2025, handing the role to his chosen successor, Greg Abel. Buffett remains chairman, but is no longer running daily operations. Here is the critical detail. Before handing over the company, Buffett spent his final years as CEO doing something very specific and very deliberate. He was selling stocks and building an enormous cash position. By the end of 2025, Berkshire's cash and short-term treasury holdings reached $373 billion. Berkshire was a net seller of stocks throughout the first quarter of 2026, selling roughly $24 billion in equities while only purchasing about $16 billion in new positions. The selling continues to outpace the buying. Now here's the question I want you to actually sit with. Is this Buffett predicting a crash? Is he telling you the market is about to collapse the way it did in 2008? The honest answer, based on everything Buffett has said publicly over the years, is no. He has repeatedly stated that he does not time the market and does not believe in trying to predict crashes. What this cash position actually represents is something more subtle and more useful for you to understand. It represents patience in the face of valuations that he personally considers too expensive right now. Berkshire's own stock currently trades at a price-to-earnings ratio of around 14 times, which is actually in line with its historical average. This is not Buffett panicking about Berkshire itself. The cash buildup is specifically about the broader market and the available opportunities within it. He is not finding businesses he wants to buy at prices he considers reasonable in the current environment. One analyst covering this in May 2026 described it perfectly. Investors who own Berkshire stock are functionally paying Greg Abel to wait. And that waiting, historically, has been an extraordinarily profitable strategy. Remember, before the 2008 crisis, Berkshire held about 66% cash. In 2002, during the dot-com crash aftermath, they held around 70% cash. The pattern across decades is consistent and deliberate. He builds cash when valuations look stretched and opportunities look scarce. He deploys that cash aggressively the moment fear creates mispricing. This is not random behavior. This is a repeatable, decades-long pattern. The most important thing Greg Abel said when taking over as CEO was this. He confirmed that Berkshire would not change its approach to investing and that maintaining a fortress balance sheet would always be the priority. He also said something that I think every investor watching this should hear directly. Buffett and Abel want to keep building cash so they are prepared when opportunities arise. Prepared. Not predicting. Prepared. This distinction between prediction and preparation is everything. Buffett is not telling you he knows when the next crash is coming. He is telling you he wants to be ready whenever it eventually does. And this brings me to the real lesson of this entire video, the one that actually matters for your life and your portfolio, regardless of how much money you currently have available to invest. You do not need $397 billion to apply this exact same principle. You need an emergency fund. You need cash reserves beyond your investments. You need the discipline to not be fully deployed at all times. Most retail investors do the exact opposite of Buffett's approach. They are most aggressively invested, most leveraged, and most excited right when valuations are highest and the market feels safest and most euphoric. Then when the crash arrives and prices actually become attractive, they have no cash left to deploy because they spent it all buying at the top, and now they are panic selling at the bottom instead. This is precisely the behavioral pattern that Dalbar's research has documented for decades. The average retail investor underperforms the market itself by roughly 4% annually simply because of this exact timing mistake. Buffett's entire approach is designed to make this mistake structurally impossible for himself. By holding cash during expensive periods, he physically cannot be a forced seller during the cheap periods that inevitably follow. Let me give you something specific and actionable based on everything we have just covered, because I do not want this video to just be admiration of Buffett without a real practical takeaway for you. First, build your own version of Berkshire's fortress balance sheet.